Good evening, everyone. We warmly welcome all of you to the session on Sri Lanka Debt Restructuring Proposal organized by the Technical Division of CA Sri Lanka. This workshop will cover the areas including the overview of the latest debt restructuring proposal, financial reporting and risk management, implication to the local banks arising from the debt restructuring agreement and the way forward. Before starting the session, virtual attendees kindly send your questions directly to the host through the Q&A option. During the session, a CPD feedback form link will be sent to you, and you are kindly requested to fill out this questionnaire by mentioning your membership number. And for those who have submitted this questionnaire are entitled to CPD. To introduce the presenter of the today's session, I invite Mr. Shanta Hallolua, Director, Technical and International Relations.
Good evening, everyone. I am pleased to introduce our presenter today, Mr. Rajit Pereira. He has experience over 15 years and currently working as a partner at Ernst & Young Sri Lanka. He is a fellow member of the Institute of Chartered Accountants of Sri Lanka and Chartered Institute of Management Accountants UK. Mr. Rajit is an experienced financial consultant with a combined experience of accounting and financial services risk management, leading the largest and only full-time quantitative financial services risk team in Sri Lanka. Mr. Rajit Pereira was a member of the Technical Advisory Task Force established by CA Sri Lanka to offer technical guidance to regulatory bodies and other institutions involved in recent debt restructuring program of Sri Lanka. Mr. Rajit currently serves as the chairman of Accounting Standard Interpretation and Implementation Committee. He also continues to work IFRS 9 implementation and validation projects in Sri Lanka, Bhutan, Nepal, and Maldives. I am sure that this session will be a great opportunity to enhance your technical knowledge. Now I am inviting Mr. Rajit to start the session. Over to you, Mr. Rajit.
Thank you, Shanta, for that introduction, and a very good evening to everyone joining online to this session to discuss some of the key implications relating to the financial services sector, specifically the banks in relation to the most recent proposal agreed between the government and the creditors, which is most likely to be finalized and proceeded hopefully towards the last quarter of this year or the beginning of next year. So during today's discussion, I'll probably intend to talk about a brief overview about the restructuring process in relation to the international sovereign bonds that are held by the local banks. And of course, give you a very quick highlight between key differences between the July proposal and the September proposal, which is the most recent one, which is likely to proceed. And then I'll develop my conversation towards as to how accounting standard implications in terms of financial reporting, what type of areas that the banks needs to be mindful, and then talk a little bit about some of the numbers relating to valuation of the ISBs based on the latest proposal as to what sort of a financial statement impact we're looking at. And then I'll move on to any questions that you have to answer. So overall session would roughly span out for about an hour, or could be a little more depending on the questions. You can use the Q&A option and send in the questions. So I'll take the questions either towards the end of the session or time to time, depending on how the time permits as I continue with the discussion. So if you look at it from a debt sustainability standpoint, well, of course, this is to set the tone with the events that unfolded since the economic crisis towards the latter part of 2021. Sri Lanka went into a preemptive default and then started the IMF pathway in order to restructure its external debt. And as a part of this restructure, the entire stock of debt Sri Lanka, which contained different categories, the private creditors, the multilaterals and bilaterals, of course, went through a series of discussions and negotiations together with the individual creditors. As the most recent outcome, where the local, the creditors, which is holders of international sovereign bonds, which of course they broadly belong to the private creditor category. The most recent proposal gave a specific outcome to the local holders, which includes the local banks, as well as few other financial institutions who are the holders of international sovereign bonds. So basically, through the IMF pathway, what was intended to achieve by way of a debt restructuring is to broadly to sustain the overall debt in terms of key major KPIs. One is the debt to GDP ratio, which they intend to bring it down below 100%, ideally towards the range of 90-95%. And then they're also looking at gross financing need, which is a key consideration for Sri Lanka, which is the financing requirement to bring in the fiscal stability for the country, where the budget deficit and also including almost all items of financing requirements in order to bring in the fiscal stability, which stands currently at about 35%, where IMF intends to bring it down to about 13.5%. So with those indicators in the backdrop, some of these conversations took place in relation to the debt restructure, and the most recent proposal, which we're going to discuss today in detail, is the proposal that they offered to the local banks in relation to their international sovereign bonds. So this is a snapshot of the summary of the holdings of international sovereign bonds in line with respective banks as at the 31st of December 2023. So numbers are presented in LKR in billions. Approximately in US dollar terms, the local consortium, which includes majorly banks, but there are few institutions who are non-banks, which are in financial services sector, also holds international sovereign bonds. The total stock of the local consortium owning sovereign bonds in dollar terms is approximately $1.5 billion. So these are presented in LKR, each bank-wise as at 31st of December 2023. So the starting point of this conversation is the local banks currently having a minimum of 50 to 52% provision that they have made over the past reporting period. They have constructively been providing for some of these losses that are preempted, which includes the day one loss, which includes the expected credit losses, and any other losses that could get attributed as a result of the restructuring process. So if you look at all of these banks, as at date, minimum provided 50 to 52% to cover some of the losses that can come from the restructuring process, which is the good news that we are starting our conversation with. So adequately, the banks have been provided for all preemptive losses that probably can come through. So if you look at what's in store with the restructure, so this particular slide tends to summarize between a comparison between your July proposal and the September proposal. If you look at the July proposal, one difference is that they did not discriminate between the local bondholders and the foreign bondholders. So that was a unique difference in the July proposal that was offered, where entire private holders of international sovereign bonds were treated equally without discrimination. You had broadly 6 types of bonds in the July proposal. One for the past due interest, the bonds which were due for settlement, bonds which were due for amortization, which were not paid on time, to consider the past due interest as a separate instrument, which carries a 11% haircut, and then to have a plain vanilla simple bond to reflect governance. So it was called the governance bond, but there was very little information to supplement the basis of the functioning of key mechanics of the governance bonds. It was a simple bond at 4% of interest. And then there were 4 macro-linked bonds issued where the haircut under the baseline scenario was 28%. And the performance of the bond was linked to the underlying performance of the economy from a dual measurement mechanic. One is the nominal GDP rate of the country, and the second one is the cumulative real GDP growth target of 11.1% offered by IMF. So depending on the economic performance, the interest rate, the haircut, or the value reinstatement would vary in these 4 macro-linked bonds. Under the baseline scenario, there was a 28% haircut, which means your performance of the bond will depend on the performance of the economy. So that was the July proposal. So if you look at the September agreement, which is the agreement which is likely to finalize and proceed towards the latter part of this year, brought in a unique change where they discriminated between foreign bondholders and the local bondholders. So if you look at in the September agreement, you can see more or less the criteria which was there in July remains as is for the foreign bondholders, whilst they offered a separate offer to the local banks, which are the local bondholders, which included the past due interest bond at 11% haircut. The balance instruments that are held by the local bank, they will split into 2 components. One is the LKR bond, which is equivalent to 30% of the face value as at 31st of March. And the second one is the 70% US dollar bond. So basically what they proposed was to split the entire ISB holding, 30% they immediately convert it to LKR instrument, while 70% they will carry at US dollars itself. And the 70% that carries at US dollar will carry a 10% haircut. So meaning effective haircut is 7%, which is 70% times 10%. Effective haircut is 7%. So for a bond with a face value of 70, we'll have a adjusted haircut. After the adjusted haircut, it will be 63. And 1.8% consent fee will remain as it is. So for the LKR bond, they did not offer any haircut. It was offered at the face value itself. And the rate to be SLFR plus 0.5%, which is at a variable rate, which gets repriced every 6 months. So this is a very quick highlight about the September proposal, which was offered to the local banks, which is likely to be finalized in terms of the overall debt restructure process. So if you look at past due interest, we did not see any difference from the July proposal to the September proposal, which is a separate instrument carrying an 11% haircut with non-linear amortization starting from 2024. Amortization will end in 2028, carrying a fixed interest rate of 4%. And the US dollar bond, there will be upfront consent fee of 1.8% on the face value, a 10% haircut on the 70% of the face value, and a non-linear amortization, which is commencing from 2029 to 2038. And the bond will be issued under the foreign law. And there will be a separate bond for LKR, which is the 30% that I mentioned, which gets immediately converted, but it will not have any haircut. But the instrument will be issued at SLFR plus 0.5% margin under the governing law of Sri Lanka. So these are a brief background about the structure of the restructuring process offered for the local bondholders. So if you look at it from accounting standpoint, the key considerations the financial institutions will have to be mindful is with these features being attached. Of course, there will be a debate around the initial measurement of some of these bonds, because one thing that we realized between the 2 proposals between July and September, the interest earning potential of these instruments have been dramatically brought down in the latest proposal. So whilst your average effective interest rate was hovering around 4 to 6% in the July proposal, in the most recent September proposal, the rates have been dramatically brought down. Initial interest rates are at 1 to 2% in the dollar bond, whilst the maximum towards the last quartile of the instrument, it goes up to about 3 to 4%, 3 to 3.5% in terms of the interest rate. So then this creates a challenge. Whilst the instrument earns a net loss in terms of interest income, that is lower margins in terms of interest income, on the other side, to compensate that loss, they have offered a relief in terms of the haircut. Because if you look at the July proposal, the proposed haircut under the baseline scenario was 28%, whilst it has been brought down to effective 7% haircut. So you can see some of the conditions attached to these instruments have negated the effect, whilst your haircut has come down. On the other side, your return in terms of your margins, interest rate also have been brought down to compensate the bondholders. So if you look at it from initial measurement standpoint, which is one of the key considerations of this instrument, this whole assessment of the swap of these instruments will have to be looked at it from a modification standpoint to the existing financial instruments in line with the requirements of the accounting standard. From a qualitative as well as from a quantitative assessment, these type of modifications will lead to a significant modification, because if you look at the swap of these two instruments will lead to recreating completely different currency profile, completely different risk characteristics of the instrument. Because earlier it was a predominant US dollar instrument, but you're right now looking at instruments being split across two different currencies, and those two instruments will carry different pricing strategies, where the LKR will be at SLFR +1, and the US dollar will at a nominal rate of 1% at the first quartile, moving up to about 3.5% towards the last quartile of the longest tenor of the instrument. So this, from a qualitative standpoint, is a significant modification. And even if you do a quantitative validation assessment in terms of trying to identify whether the modified cash flows leads to a loss which is greater than 10%, where you identify your modified cash flows of the instrument and discount at the original effective interest rate, this will lead to a more than 10% quantitative assessment. So then your determination will be, the modification will be deemed significant. So therefore, you will de-recognize your existing bonds and you will have to recognize your new bonds at the date of the swap taking place. So then the challenge is, when you recognize your new instruments in line with SLFRS 9, you will have to recognize them at fair value. So then that creates a challenge. An instrument which is carrying an effective interest rate of approximately 2 to 3%, whether it reflects the fair value of an instrument which is carrying similar risk characteristics being our external credit rating currently at restricted default category. But we are hoping once the restructure takes place on the date of the swap of these instruments, we will be rated either CCC or C levels. It all depends on the date of the swap, how your external outlook really is. But definitely at the date of the swap, you will not be RD. There's a higher probability that you will be upgraded, but there will be a debate whether it will be to CCC levels or CC levels or C levels. So that's a separate equation. So the question is whether an effective interest rate of about 2 to 3%, whether it reflects your market value or fair value or the exit yield of a similar instrument rated CCC, for example. So that's quite a challenging task, because if you really look at it from a fair value standpoint, definitely your risk-free rate, generally deemed as the US federal rate, the long-term rate is hovering somewhere around 4%. So definitely there's no chance a a triple C rated instrument to carry an interest rate below a long-term risk-free rate. So meaning you are looking at a situation where that there will be day one losses or fair value losses when you initially measure the new instrument. So you give up your existing instrument and you accept the new instrument, there's a chance that there will be a day one loss resulting due to the rate differential attached to this instrument. Apart from that effective 7% loss that you're looking at in terms of a haircut. But like I said, the good news is banks have already built a cushion of 50%. They have provided 50% of the carrying value of these instruments as estimated provisions to cover some of these losses. So you will not see additional provisions creeping into the P&Ls of the banks because you have already built those provisions through your profit and loss statement. What you're likely to see is some of these gets adjusted against the provision, which is sitting already in the balance sheets of the financial institutions. So then the next question is whether this defines a level 1 fair valuation, level 2 or level 3, because that's also an important determination in line with SLFRS 13. Because for you to have a level 1 determination of fair value, it requires to have a quoted price in active market, meaning your international sovereign bonds market stats should reflect that there is adequate market depth, liquidity, willing buyers and sellers where free market forces drive your prices of international sovereign bonds. So that's an assessment that you will have to do at the date of evaluation. So if you look at right now, yes, there are few trades that are happening. Mostly in the foreign holders, there are instances where certain people are exiting, certain people are purchasing. But the question is, you need to establish whether that reflects the fair market price. And also you need to be mindful, depending on the swap of these two instruments, how these instruments will get issued. Of course, the 30% of the local instrument will be issued separately for the local bondholders. Whether the dollar instrument, whether it's a common instrument that will be issued for all the local banks as well as foreign holders, or whether there will be a separate instrument that they will issue. Because one thing that we need to keep in mind is even within the US dollar component, there is a clause where the government has the ability to settle in LKR in the event of inability to settle in US dollars. So of course, that is not a clause which will be appreciated in the same spirit by a foreign holder, because it doesn't make sense for a foreign holder to get settled in a weaker currency, which is LKR. So of course, for the local bondholders, it makes sense because in the event of a default, the government will have the ability to settle in LKR based on the rate prevalent at the date of settlement. So that brings in a notion whether there will be a separate class of ISBs issued for the local banks, or it will be the same instrument. So if it is the same instrument, hypothetically, let's assume because it's issued under the foreign law, it will be the same instrument, but it's only a clause which says you can settle in LKR. You need to adjust it for pricing purposes, because the moment the local bank carries a clause to say, in the event of a default, you can settle in LKR, there will be some degree of de-risking that has to be brought in, because from an external market standpoint, the pricing will be driven based on the credit risk characteristics, which will include the credit risk. But when you have a settlement option in LKR, you're allowed to de-risk this because you don't technically own a credit risk, because the government will always has the ability to settle you in rupees, which I will talk about slightly later when it comes to pricing of the bond. But determination of whether it's going to be level 1 or level 2 is something that you need to look at, but definitely level 3 will be not likely. I feel at the date of transaction, we'll probably be able to arrive at either a level 1 or level 2 fair valuation for these instruments. Then the day one losses that you recognize through your profits, which have been already booked in through your P&L, will get unwounded over the tenor of the respective instrument. Well, it all depends on your business model, meaning the banks will be permitted to relook at the business model when the swap takes place. So on the date of the swap, the banks can again look at how you want to measure these instruments, whether you want to measure these instruments at fair value, whether you want to measure this instrument at amortized cost. So when I say fair value, it covers both fair value through OCI and fair value through P&L. So that decision is permitted to be relooked at by the financial institution. So depending on your business model, some of the losses that you book in will get unwounded over a period of time through amortized cost at effective interest rate. And your interest income will have to be recognized using the effective interest rate over the term of the instrument. So that's an important consideration that you'll have to keep in mind, because these bonds will have, especially the US dollar bond, will have a stepped coupon interest. It starts off in first quartile with 1% interest rate, and it ends in the last quartile at 3.5% of interest rate, which is the longest tenor. So meaning you need to recognize your income at your effective interest rate. You will not be able to look at cash-based income recognition. So in terms of expected credit loss, this is a good news. I think this is where most of banks will get benefited, because in the 52% of provision that we built in minimum, I think some banks have provided more than 52% as well. A key component was the consideration for expected credit losses. So basically, some part of that provisions were brought in by assuming a propensity of default for an instrument bearing a CCC rating into a probable haircut of 30 to 35%, or even little more, attributed certain amount of expected credit losses that banks built in within this 52% of provision cover. So now the good news is, since the US dollar component carries a settlement option in LKR to the government in the event of an inability to default, it de-risks your credit risk component, because of the fact that even in the case of a default, the counterparty will be able to settle you in LKR with the presumption that there won't be any restriction in terms of LKR liquidity. Well, it de-risks you in terms of credit risk, but it can open up avenues in terms of other risk attributes, such as your net open position. Because the fact is, when the government settles you hypothetically in LKR, it creates a mismatch in your balance sheet, the financial institution's balance sheet, the bank's balance sheet, between your assets and the liabilities, because these dollar-denominated assets were funded by the dollar liabilities. The banks will be required to purchase the dollars from the market or retain the dollars within the bank itself to bridge some of these net open positions that is created. So whilst it de-risks the credit risk, it opens up different other risks to the financial institution. But in line with the requirements of the accounting standard, net open position is not within the purview of SLFRS 9, but what SLFRS 9 talks about is the credit risk in line with expected credit losses. So the good news is, for that dollar-denominated instrument, since the LKR settlement option is there, there will not be an additional requirement for expected credit losses. But however, you need to keep in mind, for the past due interest bond, which is issued at 4%, with an 11% haircut, which also will carry a day one loss, will attract expected credit losses, because according to the wording that have been issued, there won't be an LKR settlement option relating to the past due interest instrument. So because of that, there will be a slightly different treatment in terms of your PDI instrument versus your 70% of US dollar instruments that gets converted. There won't be a requirement for ECL. And even for LKR instrument, even currently the banks don't set aside any provisions for LKR treasury bills or treasury bonds issued by the government of Sri Lanka. That is in line with the Directive 13 and 14 of 2021. We deem that these instruments are risk-free. So then there won't be incremental expected credit loss provision requirement that is coming in from the accounting standard point of view for LKR instrument. And US dollar instrument, also keep in mind, there won't be an incremental ECL provision, but that it'll open up avenues for other risks that require to be considered. In terms of deferred tax, well, it's a very subtle point. Most of these financial institutions who booked in this 52% of minimum provision also booked in a deferred tax asset with the presumption that when the losses crystallize or the losses realize, you will be allowed to claim such losses for tax purposes. So you are booked in a deferred tax asset today. There is a little bit of a gray area here because all depends on how the Inland Revenue Department interprets your interprets this for your tax purposes. If the set losses will not be allowed to set off against your taxes, it will not create a temporary difference. Instead, it will create a permanent difference. So then there is a viewpoint that some part of these deferred tax assets will have to get reversed back. So meaning, whilst we understand that there will be some part of a provision reversal also comes into the P&L, at the same time, there will be an element of a deferred tax asset also that gets reverted back to your P&L. So there can be a knock-on effect into your P&L where your gains and losses will get offset. That is purely because of how the tax law will look at these losses. Based on the current information, since your interest income from these instruments are tax exempted, the interpretation is that your provisions will not be allowed for tax purposes. So then it will not create a temporary difference, rather it will create a permanent difference. You will not be able to continue with your deferred tax asset. Instead, you will have to revert the same. So then effects to the net open position, I think this is where I spoke to you earlier. 1.5 billion is the total carrying value, which I said the local consortium owns in terms of international sovereign bonds. The 30% of this 1.5 billion, which is equivalent to approximately 500 million LKR or more, sorry, 500 billion LKR or more, 30% of this will get immediately converted into Sri Lanka rupees overnight when the swap takes place. So meaning, to the extent of $300 million minimum, to the extent of $450 million, which is $1.5 billion into 30%, $450 million, there will be a shortfall in terms of the bank's balance sheet to cover the USD position. So this will create a net open position situation for the financial institutions, meaning to cover up these net open positions, the banks will obviously be able to use an organic mechanism of retaining some of the dollars that you're getting in terms of remittances, whilst the banks who don't have adequate dollar remittances will have to purchase the dollars in the market in order to bridge this net open position over a period of time. So since this proposal is likely to get finalized, obviously you will see some of these risk management activities falling in line. So that's one type of risk that you will have to probably prevent. The second is the clause which carries in the US dollar instrument of the government's ability to settle in LKR also creates some degree of volatility in terms of a net open position, meaning since the counterparty rating is probably hovering around C levels, you will see that there will be a larger propensity of default. So generally, if you look at some of the rating agency data, a counterparty which carries a CCC or similar level of rating will have a probability of default between the range of 50 to 70%. Gets combined with a loss given default of 20%, you're likely looking at minimum of 15% probability of default for an instrument which is in the range of counterparty worthiness of CCC or similar levels. So meaning the government will have a 15% probability that they may not be able to settle in US dollars. So to that extent, probably you will have to maintain sufficient buffer from a retention and a capital adequacy standpoint to cover up your net open position in the unlikely event of government not being able to settle these instruments in USD. You're getting the settlement in dollars. It will open up a net open position for the respective financial institutions. So these are the two considerations that you'll have to be mindful. Out of the two, immediate hit of 30% will be there. Your entire exposure of 30% will get converted into LKR overnight on the data swap. So that will put pressure onto your NOP, as well as the government's ability to settle in LKR also forces you to look at that there is a probability that will happen in the future in terms of settling in LKR, which will open up your balance sheets to a net open position. So these are the two areas that you need to be mindful. So in terms of running some of these numbers based on the available information in the overall debt restructure proposal, it is likely that there will be an exit yield somewhere around 7.5% to 8.5%. So this is a slight difference between the approach that we took in July proposal, because in the July proposal, average exit yield that we looked at was between 10 to 11%. The difference between the July and the September proposal, why the exit yields have dropped, because we had to de-risk the instrument, because if you look at it from the point of view of credit risk, in July, there was no LKR settlement option for the US dollar bond. And in the September proposal, for the US dollar bond, there is LKR settlement option. So then your credit risk component will have to get de-risked. So then the adjusted exit yield will be somewhere around 7.5 to 8.5%, whilst the balance 30%, which is given in LKR itself, will not have any credit risk attached to it, which is issued at SLFR plus 0.5% of margin. So when you try to estimate this exit yield, well, of course, you can stimulate it from 2 points of views. One is you calculate your exit yield by taking into consideration the face value, the current market value of the bond, the remaining tenor, and the coupon interest. So basically, based on the published information, when we ran different options, okay, you reconstruct your exit yield by looking at the current market rates of the instrument, which is, if you look at currently, the Bloomberg pricing indicates it's about 52 to 55 cents to the dollar is the market rate for current existing ISBs before the restructure. Presuming the market broadly remains the same with limited adjustment, this information is presented to you as at today. Of course, that there will be any market dynamic changes will have to be factored in. So then you will issue 55 cents against a 70-cent face value, because if you look at, if you hold a $1 bond, that $1 bond gets converted into 70 cents in USD and 30 cents in LKR at the data swap. And then the 70 cents that you own in USD in terms of face value will have a 10% haircut, bringing down your effective face value to 0.63. So that 0.63 into 55%, so when you work out the exit yield, it approximately comes to 9.5 to 10%. That is before de-risking it, because the current market value of 55 cents to the dollar will have parameters of credit risk component being attached to it. So I have not de-risked it. So prior to de-risking, your interest rate will be about somewhere around 9.5 to 10%, or versus you can reconstruct your yield curve. Either way, when you reconstruct your yield curve, roughly your risk-free rate is currently long-term US dollar is around 3.5 to 4% maximum current long-term 10-year US dollar interest rate. And if you attribute a risk premium to an instrument which is similar to a triple C rating, so that is, I have looked at the last ISB listings that have taken place in Sri Lanka. That was between 2016 to 2018, somewhere in that range. When our external rating was B, we have had premiums of roughly about 3.5 to 4%, which will increase by about another 20% because currently we're looking at a deteriorated rating at the levels of C, not at levels of B rating. So which means it will attribute roughly 4.5 to 5% of a risk premium. So even if you construct your exit yields using the risk-free rate, either you can use a bottoms-up or top-down approach, it's fine. Generally, it comes to about 9.5 to 10%. So with a 10% exit yield, without de-risking, that is, if you attach your recovery rates, you can see that your average recovery rates would roughly be around 66%. So this is roughly 66 to 70%, meaning your loss rates are around 30%. But if you de-risk the credit risk component, so meaning in a risk premium, it's not only the credit risk which is attached, there is a risk which is attached due to term, the risk which is attached due to liquidity, as well as credit component. If you isolate the credit component only, your exit yield would be somewhere around 7.5 to 8%. So if you run an exit yield of 7.5 to 8%, roughly your recovery rate of the instrument would be 70%, which is the loss rate would be approximately 30%. So what this indicates is your fair value of this instrument at the date of swap, considering an exit yield of 7.5 to 8%, would be roughly about 70%, which is from the carrying value. So if your bond is $100, you will have a fair value of 70, meaning a loss of roughly 30% or 28% in this case, to compensate you in the rate differential. So because one thing that we need to keep in mind, a similar risk instrument, a holder would expect a return of about 8%, whilst your bond will not have the return of 8%, meaning your fair value will be less. You will have to drop the bond at a discount. So that discount is the loss of 30% that you're recognizing initially when you're accounting for this instrument. So currently the banks, I mentioned, they maintain a provision of about 50 to 52% minimum. There are banks who also maintains a provision of about more than 56 to 60%, close to about 60% as well. So you can see once this swap takes place. So general advice from the Institute of Chartered Accountants of Sri Lanka, because we have had constant dialogue with Sri Lanka Bankers Association. What we generally advise the industry was, until the swap takes place, until such time, you shall not reverse any of these provisions that were built up, because there is uncertainty. Whilst we understand that this particular proposal, there is a higher probability, the likelihood that it will go through, also until the swap takes place, that there can be certain uncertainties attached to it. So therefore, what we recommend generally the banking institutions is not to reverse. You can do your calculations, you can do your simulations, you can run your numbers, but generally we recommend not to reverse any part of this provision until swap takes place. And of course, you can expect that there will be specific guidance issued by the Institute of Chartered Accountants of Sri Lanka. In the same way, continuously we supported the local consortium as well as the Sri Lanka Bankers Association, that there will be specific guidance issued in terms of some of the key assumptions that you need to look at, because exit yield calculation, there will be certain assumptions that there will be certain adjustments that you need to de-risk your instrument. So entire industry will have to follow uniform mechanisms. So there will be specific guidances issued by the Institute of Chartered Accountants of Sri Lanka with that regard. So my request to you is, whilst we understand that there will be some part of this provision could get potentially reversed, we do not recommend it until the point of swap being taken place. But also you need to keep in mind, it's not only the provision that gets reversed, your deferred tax asset, which you have built specifically from all these losses, will also get reversed. So there will be a set off or knockoff effect in terms of your P&L, because provisions also gets reversed at the same time, asset also gets reversed. So sometimes there can be overlapping in terms of your P&L numbers. So what to expect in terms of the future, that is specifically around some of these changes that took place with regard to the debt restructure. What we saw in general in the recent quarter, specifically leading after up to September and even thereafter, that US dollar inflation, that is dollar denominated inflations, as well as interest rates, are gradually coming down. So that is an indication that your prices of US dollar denominated items will tend to ease off as the inflation is eased off. The governments, the Feds have brought down the interest rates as well, because your inflation is tend to be tapering down in the last couple of months. So the impact of this to Sri Lanka is coming from 2 points of view, because Sri Lanka is a net importing economy. We are a net importer. So when the cost of the dollar comes down, especially the dollar prices comes down, obviously it will have a direct impact to the country as well, us being a net importer. Our general price increases will also technically will have to come down. This is from a technical and a theoretical standpoint. And that will lead to affecting some parts of our inflation that we are looking at, because when the cost of prices, the cost of goods and services that we consume comes down, on the other side, it also helps us to reduce our inflation, further enabling us to drop our interest rates. Because one thing that we need to understand, which we discussed at the very beginning of our slide, the debt sustainability pathway has 2 components attached to it. Because if you look at the debt to GDP ratio, it's the numerator and the denominator that we're looking at. One aspect is your debt, the other aspect is your GDP. So whilst we sustain debt by slashing some parts of capital and interest through haircuts or prolonged repayment at lesser interest rate, also one thing that we need to keep in mind is that the economy will not be able to kickstart unless the GDP starts improving over a period of time. So the bottom line is, achieving this whole IMF debt sustainability program is not basically the end to our problems, because we have seen most of the countries that have gone through the IMF debt restructuring process have restructured their debt more than one time. So that's a likely trigger if you look at a common scenario. If you look at the recent past, the countries that have gone through the debt restructuring process. So one side, whilst it will not solve all our problems, also it opens up certain macroeconomic challenges. So the interest rates will have to come down to a reasonable level for our economic production or economic activities to kickstart. Also, one thing that we need to keep in mind as a part of this debt restructuring process, I mentioned to you earlier, 30% of 1.5 billion US dollars will get immediately converted into LKR. So which means that for banks to manage the NOP, you saw the list of banks, to manage the NOP, they will either have to retain the US dollars they have without putting it to the market, or the banks who don't have adequate flow of US dollars will have to go to the market and purchase. So meaning that will restrict the US dollar supply to a certain extent in the market. So which forces the ability to push the exchange rates up, meaning to devalue the LKR. So forcing a devalue on LKR will again create the problem, because your general price increases will start shifting upwards, meaning your inflation will start rising. To curb the inflation, you will have to push your interest rates up to curtail the demand ability of the consumer. So that creates a challenging situation. You can see that on one side, we're expecting the global dynamics, at least on a temporary note, helping us to manage the situation, but also some of these local changes can potentially create a challenge in terms of managing foreign exchange risk, which can ultimately again impact the overall macroeconomic condition as well as the GDP of the country. I think with that, we come towards the end of the session.